Okay, let's dive right in. Picture this. Apple, the tech titan, right? Back in 2013, they're sitting on, get this, $145 billion in cash.
Just an unbelievable amount of money. Billions more rolling in every month.
Exactly. So what do you think they do? Invest in, I don't know, groundbreaking R&D, expand operations, maybe boost worker wages significantly.
Sensible options, you'd think. Things that build the company long term.
Well, here's the twist. Tim Cook, the CEO then, announces they actually need to borrow $17 billion.
Borrow. With $145 billion sitting there.
Yes, borrow. And this is where it gets really interesting, because it's not just some weird Apple quirk. It points to something much, much bigger happening in our economy.
That's right. And what our sources really unpack here is that this Apple situation, it's a classic, maybe the perfect symptom of this huge trend called financialization.
Financialization. Okay, let's define that.
Essentially, it's this shift where finance, which, ideally should just be helping the real economy, the makers creating stuff, providing services, it's grown so big it dominates.
Dominates how?
Well, instead of just facilitating business, it's often become this extracting force, sometimes acting more like a headwind against broad economic growth rather than helping it along.
So less lubricant, more friction.
You put it that way. And in this deep dive, we're going to connect the dots. We'll look at these sophisticated financial strategies and see their real-world impact on businesses, workers, society.
And our mission here today
is really to understand how this massive shift happened, examine its impacts, some are quite surprising, and figure out what it all means for the economy, for society, and importantly for you listening right now.
So this rise of financialization, what does it actually mean for the average person? Because our sources argue something really fundamental has changed.
It has. Think about it historically. There used to be this clearer link, right? American companies did well, innovated, prospered.
And the average American's fortunes tended to rise too. Maybe not perfectly, but there was a connection.
Exactly. But our sources are saying the connection, it's badly fractured now. And the culprit they point to, again and again, is Wall Street.
Wall Street moving from a supporting role to the main actor.
Pretty much. Finance went from being like a necessary service industry to the dominant player, grabbing this huge, disproportionate slice of the economic pie.
Okay, give me some numbers on that. How disproportionate are we talking?
Get this. Finance as an industry, it's only about 7% of the whole U.S. economy. Creates just 4% of the jobs. Tiny slice, right?
Seems pretty small, yeah.
Yet, back around the peak of the housing boom, just before the 2008 crash, finance was generating almost a third of all corporate profits in the entire country.
Wait, a third? From 7% of the economy?
A third. Up from just 10% about 25 years before that. That's a massive shift in where the profits are flowing.
That is quite something. And the consequences.
Well, look at the aftermath of 2008. That crisis hit so many people, so hard. And what followed wasn't some quick, strong recovery.
No, it felt long and sluggish for most people.
Exactly. It was the longest and arguably the weakest economic recovery since World War II. And you saw this split, right? The very top tier, especially those connected to finance, they often did really well.
While everyone else.
While most people struggled. Stagnant wages, job insecurity, that feeling of being left behind.
Yeah.
It really suggests finance stopped being this engine for widespread prosperity and became more of a headwind, like we said, changing how wealth and opportunity flow.
Which brings us back to Apple borrowing that $17 billion. It's like exhibit A for this whole shift.
A perfect symptom.
But why? Why borrow when you're swimming in cash? What was the actual mechanism?
Okay, so the sources dig into this. The main reason, taxes. Specifically, avoiding the hefty U.S. corporate taxes on that massive $145 billion pile of cash they held offshore.
Ah, the offshore cash stash. Right.
So instead of bringing that money back to the U.S. and paying taxes on it, repatriation, they call it Apple could borrow money domestically at incredible low interest rates.
Because they're Apple. Blue chip company, great credit.
Exactly. They get rock bottom rates. So they borrow cheap money here to fund operations or, significantly, to return cash to shareholders through buybacks and dividends.
All while keeping that huge offshore pile untouched and untaxed by the U.S. government.
Precisely. It's a perfectly legal but very sophisticated financial maneuver. And it prioritizes, financial optimization over maybe bringing that money home for domestic investment or jobs.
And this is where our sources draw this contrast, right, between the Steve Jobs way and the Tim Cook way.
Yeah, it's a fascinating comparison. Jobs was famously obsessed with the product. insanely great, life-changing products. His idea was, you build something amazing, the money follows.
Product first, finance second.
Whereas Tim Cook, a brilliant operations guy, no doubt, but the sources argue he's paid much closer attention to these sophisticated manipulations of money. It became a core part of the strategy.
And this wasn't just happening in a vacuum. There was pressure from outside, wasn't there?
Huge pressure from so-called activist investors. Carl Icahn is the big example here.
Right, the corporate raider. What did he do?
So 2013, right after Apple borrows the money, Icahn starts buying up huge amounts of Apple stock. And then he starts publicly demanding, literally tweeting demands for massive share buybacks.
Using Twitter to pressure one of the world's biggest companies.
Yep. And guess what happened? Every time Icahn made noise about buybacks,
Apple's stock price jumped?
like clockwork.
Yeah.
By May 2015, his stake was worth over $6.5 billion. Shows you the power of these financial plays.
Absolutely. And Apple responded to this pressure.
They did. They ended up pledging an incredible $200 billion for dividends and buybacks through March 2017. Just a staggering amount diverted to shareholders.
Okay, but here's the crucial part, the potential downside our sources point to. What about innovation? What about the core business?
This is where it gets really concerning. The sources highlight this inverse relationship. Apple's spending on R&D research and development, the engine of future products when measured as a percentage of their sales, has actually been falling since 2001.
Falling. Well, they're spending hundreds of billions on buybacks.
Exactly. The argument is, the more a company gets laser-focused on financial engineering, on boosting that short-term stock price through things like buybacks,
the less focus or maybe fewer resources go into the long-term stuff, like inventing the next big thing.
That's the worry. It creates this kind of self-perpetuating cycle. You use financial tricks to boost the stock, which pleases investors, who then demand more financial tricks, and maybe R&D takes a back seat. It's like the sources say, maybe the business of America isn't business anymore. It's finance.
That's a chilling thought.
It is. And Apple, again, it's just this powerful microcosm for what's happened across so much of corporate America. It's not just tech.
Right, you mentioned this wasn't confined to Silicon Valley. This financialization spread everywhere.
Oh, absolutely. Our sources argue it permeated industries that were, the bedrock of American making. Think about airlines.
Okay, airlines. How does financialization show up there?
Well, sometimes airlines actually make more money from hedging on oil prices, to basically making financial bets on future fuel costs than they do from their core business. Flying planes, selling seats.
So they become speculators in the oil market.
In a way, yeah. It diverts focus, resources, and introduces huge financial risks. If those bets go wrong, and they sometimes do, it can cost millions, even billions, directly impacting the airline itself.
Okay, so that's a diversion from the core mission. What about a more fundamental transformation?
For that, the classic, maybe the most dramatic example is General Electric, GE.
GE, Thomas Edison's company. The light bulb, jet engines, the epitome of American industry for generations, a real maker.
Absolutely. But then came Jack Welch as CEO in 1981.
Neutron Jack, that nickname tells a story.
It really does. He was famous for ruthless cost-cutting to boost the stock price, fired 112,000 people in his first 5 years. But the bigger shift under Welch was the massive expansion of GE Capital.
Their finance arm. Wasn't it originally just for, helping people finance GE appliances?
Initially, yeah. But under Welch, it exploded. It grew from a small support unit into this sprawling financial giant. Too big to fail institution in its own right.
Doing what kind of finance?
Everything. Aircraft leasing, complex derivatives, leveraged buyouts. And, crucially, they got heavily into subprime mortgages.
Ah, so they were part of the 2008 mess, too.
A big, if maybe less talked about part.
Yeah.
By 2008, GE Capital had almost $700 billion in assets, bigger than many major banks. And it needed a massive taxpayer bailout, $139 billion.
Wow. The quintessential industrial company needed a bailout because its finance arm got too big and risky.
It's a stark illustration, isn't it, of how far a company can drift from its roots when finance takes over.
But didn't GE eventually try to reverse course?
Yes, that's also part of the story. Jeffrey Immelt, Welch's successor, eventually recognized the danger. In 2015, he made this landmark decision to spin off most of GE Capital. He basically admitted it had become a drag. Too risky, too far from their core. He called GE Capital a canary in the coal mine for corporate America, signaling a return to GE's industrial identity, a recognition that chasing financial returns above all else had hollowed them out.
That's fascinating. So this mentality, this focus on finance over making things, our sources call it the Bolt business mentality.
Yeah, it's this idea that companies start treating their actual productive capacity, their factories, their expertise, their ability to make, say, high-quality bolts is just another commodity.
Less focus on making better bolts, more focus on
Bringing more money, from financial transactions, from managing cash, from optimizing balance sheets, rather than investing in the core business of making bolts.
Can you give examples of companies that fell into that trap?
Kodak is a tragic one. Everyone knows Kodak. Photography.
Synonymous with it for a century.
Their own scientists invented the first digital camera. But management, focused on protecting the existing high-profit film business, largely ignored digital.
A classic innovator's dilemma, but driven by financial short-termism.
Arguably, yes. The result. From 145,000 employees and $19 billion revenue in 1990, they trashed. After bankruptcy in 2013, they had just 8,000 employees and $2 billion revenue. Just devastating.
Wow. Any others?
Westinghouse is another stark one, a giant of American manufacturing electricity, appliances, nuclear power.
Right. Another titan.
But starting in the 80s, under pressure to boost the stock price to unlock shareholder value, they were systematically dismantled. Consultants came in, advised selling off piece after piece.
Sold off the actual making parts.
Yeah. By 1997, the company that built power plants was reduced to just a media company. And today, what's left of that industrial giant is basically just CBS, the TV network, a shadow of its former self.
And Sara Lee, the food company.
Similar story, different sector. They shed their manufacturing, the bakeries, the factories, to focus just on brand management. Again, maximizing profit margins on fewer physical assets, prioritizing the spreadsheet over the production line.
It's really unsettling, especially when this financial thinking spills over into essential things like food.
Absolutely. That anecdote from Josette Sheeran, the former UN World Food Program head, is so powerful. The little red cup.
Representing a day's worth of porridge for a hungry child.
And she'd show world leaders how the doubling of food prices in 2008 pushed an extra 140 million people into hunger. Just heartbreaking. And a big driver of that price surge, the sources argue, was financial speculation in food commodities.
So traders betting on the price of wheat or corn, driving it up?
Essentially, yes. It raises that critical question. When finance gets involved in necessities like food or energy, who does it really serve? The public good? Or mainly itself?
Because Wall Street could trade these futures.
Often using our retirement money, by the way, through pension funds and mutual funds, contributing to this runaway inflation that makes basics unaffordable for millions.
And it creates these conflicts of interest, right? The fox and the hen house thing.
Exactly. This is really crucial. Big financial players like Goldman Sachs weren't just trading commodities, they were allowed to own the physical stuff too. The actual aluminum, the actual oil, sitting in warehouses.
Wait, they could trade aluminum futures and own massive stockpiles of physical aluminum?
Yes, which gives them incredible market power and insight. They can potentially manipulate supply, hoard resources, and compete directly with the manufacturers who need that aluminum.
That sounds incredibly problematic. Is there a specific example?
The aluminum hoarding case involving Goldman and a warehousing firm called Metre International is infamous.
What did they?
They legally exploited warehouse rules. By shuffling aluminum between warehouses, they created massive artificial delays in getting that metal to manufacturers who had bought it. Sometimes delays stretched over a year.
Just to, what, drive up the price?
Precisely. The long storage created artificial scarcity and allowed them to charge higher storage fees and premiums. Goldman profited from the warehousing operation and potentially from trading aluminum derivatives based on their inside knowledge of these orchestrated delays.
Meanwhile, the company that actually makes things with aluminum
Faces higher costs, which ultimately get passed on to you, the consumer, in higher prices for everything from cars to soda cans.
and regulation didn't stop this.
For a long time, these commodity derivatives markets were the Wild West, very lightly regulated. Proving manipulation is also really hard, especially when owning the physical asset and trading its derivatives is perfectly legal. Senate investigations into Goldman's aluminum dealings highlighted how tough it is to prove deliberate wrongdoing, even when the situation looks deeply suspicious.
It really feels like a system rigged against the real economy sometimes.
It creates this perverse situation where businesses are competing with their own bankers for raw materials, and finance extract profits at multiple points, driving up costs for everyone else.
It is frustrating, and you get the sense that the regulators, the ones meant to prevent this, are often compromised or captured.
Our sources definitely paint that picture. The government's role or complicity is undeniable. You see this long, slow rollback of the tough regulations put in place after the Great Depression. Rules like Glass-Steagall, meant to keep banking safer.
Rolled back why? Under what justification?
Often under the banner of markets know best. Deregulation, letting finance innovate. But it allowed the sector to grow enormously powerful and largely unchecked.
And the financial lobby in Washington, I assume it's pretty powerful.
Immensely powerful. Our sources show finance consistently outspends nearly every other industry on lobbying. We're talking billions. In the 2013-14 cycle alone, $1.4 billion.
Wow. And that money buys influence.
The data suggests it does. Financial PACs gave significantly more, like 2.6 times more, to politicians who voted in ways favorable to the industry. It helps them shape the rules, weaken oversight, tailor the tax code, often very quietly.
Then there's the revolving door, people moving between Wall Street and top government jobs.
Yes, that's a huge factor. Top spots at Treasury, the SEC, the CFTC, the agencies regulating finance are frequently filled by former executives from Goldman Sachs, Citigroup, places like that.
Robert Rubin, Hank Paulson, both Goldman guys who became Treasury Secretary.
Exactly. It creates what the sources call cognitive capture. Regulators, steeped in the industry's culture, maybe hoping to return to lucrative private sector jobs later, might just be less inclined to police it aggressively.
They might share the same worldview, see things from the industry's perspective.
Right. Plus, they're often outgunned. Fizzing complex financial schemes devised by traders earning vastly more with fewer resources. It's an uneven fight.
And even after a massive crisis like 2008, the system wasn't fundamentally fixed.
That's a key argument, a missed opportunity. Compare the AIG bailout in 2008 to the long-term capital management bailout back in 1998.
What was the difference?
In 98, the New York Fed pressured private banks to pony up the money to rescue the failing hedge fund. Shared responsibility. In 2008, with AIG, the government put taxpayers on the hook for the massive bailout.
So, private profits, public losses.
That's the pattern it points towards. A system where the gains are privatized, but the risks, the costs of failure get socialized. It shows who has the power when things go really wrong.
This connects to another area our sources explore: business education, how we train future leaders.
Yeah, this is a really insidious part of financialization. If you're training the brightest minds primarily in financial engineering, not in, say, building great products or managing people ethically.
You embed that financial focus right into the core of business.
Exactly. And historically, business education wasn't always like this. Joseph Wharton's original vision for the Wharton School was practical, industry-focused, even emphasizing ethics.
But something changed.
Post-World War II, there was this push, funded by big foundations, to make business education more like hard science. More quantitative, more abstract models.
Enter Robert McNamara and the whiz kids at Ford.
A pivotal moment. These guys were brilliant statisticians from the war effort. They brought this cold rationality, this management by numbers culture to Ford.
Focusing on cost-cutting metrics.
Ruthlessly. They sidelined the car guys, the engineers and designers who actually loved cars. Finance became the control center. Everything judged by the numbers.
Did it work?
It led to quality problems, and famously to flops like the Edsel, a car designed by spreadsheet, not by passion. It showed the limits of purely quantitative management.
And this whiz-kidding spread through American industry, bean counters over craftsmen.
That's the argument. Prioritizing quarterly earnings and stock price above everything else, making money from money became more prestigious than making great things.
And modern business schools, have they course-corrected?
Our sources argue largely no. Top MBA programs still heavily emphasize Finance 101, often meaning complex models, derivatives, balance sheet optimization.
Skills for extracting value, maybe, more than creating it?
That's the critique. Less focus on real leadership, curiosity, ethics, long-term thinking. Even some deans admit it's easier to teach financial modeling than how to be a curious, humane, ethical leader who can resist Wall Street's short-term pressures.
And the financial theories themselves, they held up.
Well, the 2008 crisis was a pretty stark challenge to the idea that financial models are perfect or that markets are always efficient, wasn't it? The models didn't predict or prevent it.
And this focus draws talent away from other fields, right? The brain drain.
A huge issue. Physics PhDs, brilliant mathematicians, top engineers getting lured to Wall Street by salaries 4 or 5 times what they'd make in research or industry.
So instead of designing the next breakthrough technology,
they're building 12-dimensional computerized trading models to create exotic financial products, often sold to pension funds or municipalities, extracting fees along the way. diverting top talent from productive innovation to financial abstraction.
Which brings us back to incentives. Can we change the underlying drivers?
That's the multi-trillion-dollar question, isn't it? It requires a fundamental shift in mindset, seeing finance as a tool to serve the real economy, not as the end goal itself.
And a big part of the problem is how we structure things, right? Tax code, corporate rules.
Absolutely. It's not just market forces. It's a system engineered to favor certain outcomes, often through our own laws. The result: wealth concentrates at the top, real wages stagnate for most, even when productivity goes up.
You mentioned the Dodge v. Ford case earlier. How does that fit in?
It was a landmark case from 1919. Why complicated? It helped establish this legal precedent that shareholder interests, maximizing profits for them, should generally come first, ahead of workers, ahead of community investment.
Shareholder primacy.
Exactly. It laid groundwork for the principal agent problem we see today.
Explain that again, principal agent.
The shareholders are the principals, the owners. The executives, the CEO, are the agents supposed to act in the principal's best interest.
Right.
But when the CEO's pay is mostly stock options tied to the short-term share price, their personal incentive is to pump that stock price up now, even if it means cutting R&D, laying off workers, or taking risks that hurt the company long-term.
Because Wall Street analysts are focused on the next quarter's earnings, not the next decade's strategy.
Often, yes. It creates this relentless pressure cooker for executives to hit short-term numbers, sometimes at any cost.
And the most visible sign of this is share buybacks.
Absolutely staggering amounts. S&P 500 companies, 2005 to 2015, $4 trillion on buybacks, another $2.5 trillion on dividends.
Trillions.
And get this, in 2014 and 2015, the total spent on buybacks and dividends was more than their net earnings, 105%, 115%.
Spending more than they earned. How?
Wow.
Borrowing.
Often, yes. Borrowing money not to invest in the future, but to funnel cash back to shareholders and boost the stock price. It's funding the stock market, not the real economy. And often, they buy back shares when the market is high, basically wasting company money.
And the tax code encourages this.
Oh, profoundly. Our nearly 75,000-page tax code is riddled with incentives that favor debt over equity. That's great for banks who issue debt, but not always great for long-term stability.
Example.
Corporate tax inversions like Pfizer trying to buy a smaller foreign firm just to move its tax address offshore. That's pure financial maneuvering to avoid U.S. taxes.
And Apple keeping cash offshore while borrowing for buybacks.
Another perfect example, using the tax code to prioritize shareholder returns over domestic investment or tax contributions.
And it's not just corporations, right? Consumer incentives, too.
Yes. Deductions for student loan interest, mortgage interest. These encourage borrowing. And the mortgage interest deduction overwhelmingly benefits wealthier households. 90% of its value goes to those earning over $75K. It even used to let you deduct yacht interest.
Wow. So the code encourages debt, discourages saving.
To a large extent, yes, it fuels consumer debt, tying individuals more tightly into the financial system.
So this whole makers versus takers debate, our sources flip it on its head.
They really do. Some politicians use takers to mean people on benefits, but these sources argue, look closer. Who's really taking a disproportionate share? Often it's the financial elite, the supposed makers, paying lower effective tax rates, benefiting most from these engineered incentives, and pushing business models that work against broader growth. It redefines who benefits and who pays.
It really is infuriating when you see how it plays out, especially in areas like housing and retirement basic security.
The housing crisis didn't just end in 2009 for many communities. Places like San Bernardino, still scarred by foreclosures, blight, high unemployment. And getting a mortgage became much harder for ordinary people.
Even as the national market recovered in some areas.
Right. And this is where financialization hits home, literally. The American dream of owning a home. It's getting tougher. Why? Partly because huge private equity firms swooped in after the crash.
Blackstone's Invitation Homes, others like them.
Exactly. Armed with billions in cash, they bought up hundreds of thousands of foreclosed single-family homes, often outbidding regular families and nonprofits. They became the biggest landlords in the country, almost overnight.
Just renting them out.
But it's more complicated. They started doing something eerily familiar, securitizing the rental payments.
Like with subprime mortgages, bundling income streams and selling them off as securities.
Precisely. Taking thousands of rental agreements, packaging them, and selling bonds backed by that expected rent revenue to big investors creates a new, opaque, debt-fueled market.
What are the risks there?
Rents go up, making housing less affordable. Homeownership rates decline, they hit a 20-year low. It creates instability for renters, potential for another crash if this rental-backed securities market sours, and it harms communities as absentee landlords have less local connection. Plus, these firms lobby against tenant rights.
And this shadow banking sector, private equity, it's growing.
Massively. Grew 10% in 2014 alone, reaching $36 trillion globally. It's where the money, the talent, and often the highest risks are concentrating now.
Okay, let's shift to retirement, the tsunami you mentioned.
Yeah, the story of Paul Ladroni, educated, professional, yet struggling in retirement. It's a reflection of a huge crisis. Over half of Americans haven't saved enough. The median savings for households near retirement. Barely over $100,000. That's nowhere near enough.
And the traditional supports are crumbling. The three-legged stool.
It's basically been kicked over. Leg one, Social Security. Effective, but constantly attacked and underfunded.
Leg two.
Pensions.
Defined benefit pensions, the kind that guaranteed income for life, largely gone in the private sector. Companies ditch them to boost profits. Public pensions remain, but are often underfunded and, critically, vulnerable to Wall Street deals.
Which brings us to leg three, personal savings, like 401k.
The shift to 401ks has put all the risk on the individual, and it's opened the door for Wall Street to take a huge cut through fees.
John Bogle's warning.
The Vanguard founder. His stark calculation. High fees on mutual funds could eat up 65% or more of an investor's potential long-term returns.
65%, just in fees.
Over a lifetime of saving, yes. Management fees, trading costs, they compound. And the kicker, most high-fee actively managed funds don't even beat low-cost index funds over time.
So people are paying more for worse results.
Often, yes. The system incentivizes complexity and high fees, turning investing from a fiduciary duty into a high-profit business for the financial industry, fueled by our retirement savings. The Detroit bankruptcy example really brings the pension issue home, doesn't it?
A brutal illustration. In the mid-2000s, Wall Street banks sold Detroit $1.4 billion in complex, risky deals, pension obligation bonds, interest rate swaps, highly leveraged bets.
Designed to help the pension fund.
Supposedly. But when the market crashed in 2008, these deals blew up, costing the city hundreds of millions. And who did the banks demand get paid first?
Themselves.
You got it. While pensioners, teachers, firefighters, city workers were facing huge cuts to their retirement, the bankers who structured these risky deals were demanding full payment.
That sounds predatory.
It felt that way to many in Detroit. But, importantly, they fought back.
How?
Activists, local leaders, they pushed back hard. A judge eventually forced the banks to settle the derivatives deals for a fraction of what they demanded. And there was that amazing grand bargain.
Right, private donors stepping up.
Yeah, contributing hundreds of millions to save the city's art collection and soften the pension cuts. It showed that communities can resist financial extraction, even against powerful forces.
A glimmer of hope there? It shows it's possible to fight back.
It does. It underscores how vital it is for cities, for all of us, to understand these complex deals and for regulators to be much tougher. So, the big question, where do we go? How do we re-anchor finance to the real world?
Our sources suggest starting with the purpose of corporations themselves, moving beyond just maximizing shareholder value.
Exactly. Challenging that core tenet and looking at leaders who already do things differently, like Howard Schultz at Starbucks.
Investing in employees' healthcare, tuition, even when Wall Street grumbled?
Yes. He saw it as good long-term business, building loyalty and brand value. He explicitly said responsibility goes beyond just the stock price.
And Mark Bertolini at Aetna.
He raised the minimum wage to $16 after realizing that secure, engaged employees were the real competitive advantage, the scarce resource, not just a cost. He even gave executives copies of Piketty's Capital, urging them to think bigger.
Are there different structures for companies that work?
Absolutely. Worker cooperatives, like Ocean Spray or W.L. Gore. The workers own the company. Incentives are aligned differently, focus on long-term stability, shared prosperity.
And the German model, co-determination.
Where labor reps sit on company boards, have a real say. It fosters collaboration. Look at BASF, the chemical giant. During the 2008 crisis, they avoided mass layoffs by retraining and reassigning workers. They kept their skilled workforce intact, ready for the recovery, much more stable.
So, changing corporate purpose and structure, what about reforming the financial system itself?
Advocates call for simplicity. Maybe returning to something like Glass-Steagall, that clear separation between regular banking and risky investment banking. Just 37 pages compared to Dodd-Frank's 2,300 pages of complexity.
Simpler rules, harder to evade.
That's the idea. Clarity, accountability, then there's tax reform.
How could taxes help?
Shift incentives. Reward saving over debt. Reward long-term investment over short-term speculation. Maybe higher top tax rates, closing loopholes for performance pay, taxing capital gains less if you hold assets longer, reforming things like the mortgage interest deduction.
Make the tax code favor making things again, not just financial maneuvering.
That's the goal. And rethink Fed policy, too.
Oh, so.
The Fed's low rates and quantitative easing mainly inflated asset prices, benefiting the wealthy who own assets, and fueled corporate debt. It didn't do much for middle-class wages.
So instead of just monetary policy,
You need fiscal stimulus, real government investment in infrastructure, R&D, worker retraining, things that boost the real economy directly, not just financial markets.
Okay, here's an interesting idea from the sources. Could the big asset managers, BlackRock, Vanguard, Fidelity, actually be part of the solution?
It's a fascinating possibility. These firms control a huge chunk of the stock market, like 65% of all shares.
They have immense potential power over corporations.
John Bogle himself said, "We are Adam Smith's invisible hand." His point was, these huge managers could use their voting power to demand better corporate governance, push for long-term thinking, resist the demands of short-term activists.
Could they force companies to focus less on financial engineering?
Potentially. It could be a powerful lever to shrink finance back to a more supportive role, ensuring more wealth flows to real investment and workers, not just financial intermediaries. It's a big if, but the potential is there.
Of course, none of this is easy. Finance isn't simple physics.
No, it's much more like messy biology, as one source puts it. Unpredictable, driven by human behavior, prone to error. We have to stop pretending financial models are perfect predictors and embrace the complexity.
But the stakes are huge, aren't they? It's not just about economics.
Not at all. It's about having an economy that actually works for most people. It's about fighting that Hobbesian hopelessness, that feeling of insecurity and struggle. It's about making finance serve us, not the other way around.
So we've dived deep into how Wall Street came to dominate Main Street, how finance became more about, well, taking than making. It leaves us with a really critical choice, doesn't it?
It absolutely does.
And the question for you listening isn't just what stands out to you, it goes deeper. How might your choices, as a consumer thinking about where your money goes, as an investor pushing for transparency and real value, as an employee advocating for better practices, or just as a citizen demanding change, how might your actions help nudge things back towards a system that genuinely serves everyone, not just the few at the top? Is it maybe time we demanded that the invisible hand feels the touch of Main Street again?